Everyone is concerned whether the stock market is expensive or not. And everyone is talking about the very high P ratios of the S&P 500, and that historically, when the S&P 500 is so expensive in terms of P ratios, the future returns are quite low. So in this video, I'm going to tell you what I think about the current P ratio, whether I think the market is expensive or not, what's going to happen in the future, and how I'm positioning my portfolio. And I'm going to share with you a bunch of ETFs that can be a very good alternative to the S&P 500 if you believe the S&P 500 is expensive. So, without further ado, let's get straight into it. Okay, first, let's just talk a little bit about what the P ratio is. P ratio is basically the price of the stock divided by the earnings per share. So the price of the stock divided by the earnings of the company, earnings per share, basically measures how expensive the price is compared to the profits of the company. Makes sense, right? Now, you might have a high P ratio because either the stock is expensive or because people are very optimistic that company will generate lots of profits in the future. A low P ratio is not really a good measure to say that the company is cheap, okay? A company might have a low P ratio because people are not optimistic about that business, or because that business requires a lot of investment. So when people compare the current P ratio of the stock market with the historical P ratio that used to be like 15 or 17, they are really comparing apples to oranges. Because currently, the top companies in the S&P 500 are tech companies, software companies, AI companies. They can generate much more profits than the companies that used to be the top companies 30, 40, 50 years ago, which used to be like oil companies, manufacturing companies, car manufacturing companies, that the profit margins are much smaller. So they used to generate less profits, less earnings, and consequently, the price to earnings ratio used to be also more cheap, right? So when we say that the stock market, no, my God, is expensive, I will share with you some charts. Oh my God, the stock market is expensive because the P ratio is at 32. Well, maybe it's not expensive. Maybe you're just living in a new world where companies' profitability is much higher. Okay, I think the best is really to start sharing here the screen with you. And what we see here. So we see here that over the last, this is what, 15 years? Yes, the P ratio, which is the blue line, you can see the scale on the left, is at close to 32. So it's close to all-time high. Actually, in 2020, it was a bit higher. And people are like, oh my God, is this expensive or not? Well, I'm going to show you that this P ratio is high because there is a small number of companies in the S&P 500 that are pushing up the P ratio. And these AI companies people expect lots of profits, lots of earnings, but it doesn't mean that the entire stock market is expensive. You still have hundreds of opportunities in the stock market that are not that expensive. And I'm going to show you in a bit how to invest in these opportunities. So let me show you this stock screener that kind of justifies why these companies' valuations are so high, and why the stock market seems to be expensive. It's expensive, but there is one great indicator that is going to tell you whether it's really expensive or the market is just going up because companies are making more money. And that's the case. So earnings of companies are exploding. In fact, last week, hundreds of companies reported their earnings, and the earnings are really going up. The revenue, the earnings are going up. And here what we can see is that I put here the filter companies from the S&P 500 that have a revenue growth over 20% and gross profit margin growth also over 20%. And you have 53 companies that match these conditions. So you have 53 companies out of the 500 companies of the S&P 500 that have a revenue growth over 20% and the gross profit growth of over 20% also. And as you can see here, many of these companies, okay, I started here by P ratio, many of them have a high P ratio. They have a high P ratio because they are growing a lot, okay? And if they continue to grow because AI demand and so on, they might justify these high valuations. So yes, you hear like Datadog, Palantir, AMD, Broadcom, these are AI-related companies, and that might be the reason why the PE ratio is going up so much. However, if I switch here, I'm going to remove these, and I'm going to put here, for example, DJI, Dow Jones Industrial Average. Actually, the PE ratios of most of the companies in the DJI are not that high, right? So probably the average PE ratio, the mean PE ratio of the Dow Jones Industrial is like around 20 or so, not high at all. Let me show you other indices. So if I put here, let me choose these S&P Industrials, you also see that the P ratios are not high. Of course, you have a handful of companies that have a high P ratio because they are growing a lot, whatever. But you scroll down and you have a very long tail of companies that have P ratios of 20, of 10, and so it's not that high, okay? And when people are looking at the historical P ratios, again, companies that used to be the top companies 30, 40, 50 years ago, they are looking at these industrial companies. And of course, industrial companies have lower P ratios than software, tech, AI companies. Now, very important to say, if you are still concerned that the S&P 500 P ratio is very high, let's say you are investing in the S&P 500 index fund like VOO or SPY, or you are investing in NASDAQ 100 funds like QQQ, or you are investing even in leverage ETFs such as QLD, UPRO, SSO, leverage ETFs that I share all the time in my community. And if you are concerned that these S&P 500 or NASDAQ might be too expensive because the Max 7, these tech companies, are bringing the P ratio very high, I have some solutions for you, okay? So now I'm about to share with you some ETFs that track mid-cap and smaller cap companies. By the way, what's market capitalization? Market capitalization is just basically the price of the share multiplied by the number of shares out there, right? And this is basically the total valuation of the company. So you have ETFs that track not the big companies, the S&P 500 or the NASDAQ companies, but that track smaller cap or mid-cap companies, companies that are not too big, not too small. And historically, in moments of crisis or crashes, these mid-cap ETFs often outperform the S&P 500. I'm going to show you the charts. But let me just share with you which ETFs am I talking about. So first, I want to start by sharing RSP. RSP is the equally weighted S&P 500 ETF. So basically, the S&P 500, the normal S&P 500 ETFs like VOO or SPY, they give a weight to the companies according to their market cap. So of course, these companies like Nvidia, Amazon, Meta, they have a very big market cap, so they have a bigger weight in the S&P 500 normal funds. In fact, the Max 7 companies, the top 7 companies, weight 30-something% of the S&P 500, and those are the companies that are bringing the S&P 500 valuation so expensive, so high. So you can invest, potentially, the one that I'm sharing here on the screen, RSP. RSP is the equally weighted S&P 500 ETF, and equally weighted basically means that each company, instead of having a weight according to their market cap, and big companies have a very big weight in the S&P 500, in this basket of companies, each company has the same weight of 0.2%, okay? Because it's basically 100% of the weight, right, divided by 500 companies. Each company weighs 0.2%. So it doesn't matter if it is Nvidia or Palantir or Google or whatever. These companies have all the same weight of 0.2%. So it gives less weight to the big companies and gives a little bit more weight to the little ones that are still part of the S&P 500. So as you can see here, if you have invested, let's say, in late 2022, and you have invested in equally weighted S&P 500, here the RSP, you are underperforming. Because, of course, in the S&P 500, these Max 7, you have Nvidia going crazy, you have AMD and Intel and Amazon and Google going up so much. Of course, if you are investing in an ETF that gives less weight to those companies, you will be performing a bit less, right? But in case there is a downturn, I think these RSP ETF might perform better. In fact, there are a few points in history where it performed better. Look at this. For example, In 2013, right, 2013, 14, 15, 16, 17, there was here a long period where RSP was performing better, right? While during this period, the S&P 500 returned 96%, RSP returned 120%. And probably there are many other points in history where RSP perform a bit better than the S&P 500. So this could be potentially an option for you. Oh, and by the way, you also have the leveraged version of RSP. It's called URSP. And it's a recent ETF, so here on the chart you have only a little bit of history, but URSP gives you 2x leverage on the RSP. I talk about leverage ETFs all the time and why you should invest in a portion of your portfolio into leverage ETFs, something called the Kelly criterion, risk adjusted returns, and so on. I talk about everything and much more on my Henry Wealth Academy. And also I have a full course, 4 hours long, about leverage ETFs if you want to learn more about it. Anyway, what's next? So the next ETF I want to cover is DIA. DIA is the Dow Jones Industrials. Okay, so this is an ETF that includes 30 companies, 30 of the biggest companies in the US, but their P ratios are on average smaller. So as you can see here, it's kind of highly correlated with the S&P 500, but again, there are also some periods where the DIA perform better. For example, this period 2016 to 2020, Dow Jones Industrial returned 78%, while the S&P 500 returned 56%. And maybe who knows if there is a market downturn because these companies are so expensive, DIA will perform even better. If you want the leverage version, 2x leverage DIA, Dow Jones Industrial, is the DDM. So DDM gives you 2x leverage, and during bull markets, look at this, performs quite well. So if you believe that the Dow Jones Industrials can be the ETF, or the index that will beat the S&P 500, look at this. For example, from 2015 approximately to 2020, we have this period where S&P 500 returned 70%, Dow Jones Industrial 98%, and DDM ETF over 200%. Okay, of course, past returns do not guarantee future returns, but I'm just giving you the options that you can diversify away from S&P 500 and tilt towards lower P ratio companies. That's what I'm trying to do here, okay? I'm not giving financial advice. I'm just giving you the options where if you are so concerned about high P ratios, you can invest in these options with a smaller average P ratio. Okay, next I want to share with you IWM. IWM is the Russell 2000 ETF. And Russell 2000, if you look just over like the last 1 year, has been performing very well. In fact, in my Henry Wealth Academy, I recommended a year ago Russell 2000 and recommended also TNA. TNA is the leverage version, the 2x leverage Russell 2000, which in 1 year alone returned 136%. Beautiful, beautiful. We have an 80% success rate in my trade alert. I put everything in my academy if you want to take a look. Anyway, let's take a look here at the 5-year performance. 5-year performance, of course, it has been much lower, but there are, again, periods in the market where the S&P 500 was underperforming and the Russell 2000 was performing better. Okay, well, okay, here, for example, here this was what, 2016, 17, 18. As you can see here, S&P 500 returned 39%, IWM returned 58%, and TNA 200%. Okay, very crazy returns. And these are mid-cap companies, so Russell 2000 doesn't have the blue chip, big companies, overvalued companies, have like small and mid-cap companies, and it's composed of 2,000 different companies. So when you invest in these ETFs, you have automatic exposure to 2,000 different companies. Okay, one more recommendation. Small cap, S&P small cap index, you can invest with IJR. So these are The companies, let me change here the color because this is not very easy to see if we are using almost the same color, right? Okay, let's put pink. Here's pink. Okay. And these are also smaller capitalization companies, small cap companies, 600 of them. And also there will be points in time where they perform better. For example, here, 2013, 14, 16, okay? Heavier periods where it returned much better than the S&P 500. And again, if you want to have the leverage version, you can go to SAA. SAA is 2x the S&P small cap 600, and it will give you better returns. Now, of course, you should diversify, never go all in into these ETFs. And also, if you want to understand a little bit about optimal leverage, here on TradingView, you can check the Kelly criterion curve. This is an indicator that I have created myself, and that will give you the optimal leverage for your ETFs. And if you load here the Kelly criterion curve, and you need to put a time frame that is a bit better, let's put here 2000 days, for example, you will see that in this case we have loaded the SPX, S&P 500, okay? And what we see here is that the optimal leverage for the S&P 500 will be 3x. 3x might be too volatile, so we use half Kelly, which is 1.6x. So if you add a little bit of leverage to these indices, to the ones that I have been talking about, that's why I'm always talking about leverage ETFs, you get better risk-adjusted returns. Of course, more than a certain level of leverage, then it will eat up your returns. It's not worth it. That's why you have here this declining line, okay? This declining line. And if you invest too much, it just basically goes to zero, okay? But you get the point, right? I talk about these all the time in my academy, but I hope that by now you have some alternatives to tilt away from the large cap, expensive S&P 500 companies. And if there is a market downturn, you will be a little bit more diversified with companies that are not those like big P ratio companies. All right, I hope you have enjoyed this video. If you enjoy, I'm sure you have enjoyed, give it a like and subscribe, and I'll see you soon.